Hello, my name is Ken Murdoch. I'm not a financial planner or advisor. I'm not here to sell you anything, and I'm not trying to build a client list. I am an experienced investor, a former stockbroker, and today I'm a professor in the College of Business at a large state university. I've made some investing mistakes early in my investing experience, learned from them, and spent decades studying markets, both in the classroom and in my own portfolio. I'm not a riverboat gambler personality by any stretch of the imagination. Having said all that, today I want to challenge one of the most widely accepted ideas in retirement investing. What if the 60-40 portfolio, 60% stocks, 40% bonds, is not just outdated, but actually holding you back in your investing? For decades, the 60-40 portfolio and the 4% withdrawal rate were considered gospel in investing. The idea was simple: balance growth with stability and withdraw 4% annually to avoid running out of money. But here's the problem. Those rules were built for a different world, a slower, less connected, and less volatile world. Technology moves markets today. Technology drives innovation, and global events ripple instantly. The old rules, they don't reflect the speed, complexity, or the opportunity of today's markets. I'll be very direct. I invest 100% of my portfolio in stocks, no bonds. Why? Because over the long term, stocks have consistently outperformed bonds even when accounting for volatility. Bonds may offer short-term stability, but they come with a long-term opportunity cost that is the growth you missed by not having those dollars in stocks. A 100% stock portfolio gives you the best chance at building real wealth, and that's especially important if you plan to withdraw conservatively in retirement. Now, you might be thinking, well, what about market crashes, downturns, unsettling events? What if I need money when stocks are down? That's where the cash buffer comes in. I keep 12 to 18 months of living expenses in cash or cash equivalents, like high-yield savings or money market funds, all the time. That cushion gives me peace of mind and the flexibility to ride out downturns without selling stocks at a loss. It's a simple strategy. Stay fully invested for growth. Use cash for stability. Yes, stocks can be volatile, but history shows that market downturns are often short-lived. In 2008, the market crashed and recovered. In 2020, the pandemic hit and the markets bounced back again in months. Even in 2022, after a rough year, the market rebounded in 2023. From 2000 to 2025, the S&P 500 has delivered 7 to 9% average annual returns, depending upon whether you reinvested dividends. Those returns include the dot-com bust, the Great Recession of 2008, COVID, and more. The long-term trend, it's always been up and to the right on the performance graph. Now, I get it. Not everyone wants to research individual stocks. Most people don't have the time, the interest, or the expertise to do that. But here's the good news. You don't need those things. Companies like Fidelity, Vanguard, Schwab, and others offer low-cost index funds and ETFs that give you exposure to the entire market or specific sectors, if that's what you prefer, with professional management and decades of performance data. These funds are diversified, they're transparent, and they're proven to recover from downturns over time. So even if you're not a stock picker, you can still build a 100% stock portfolio that's simple, diversified, and built for long-term growth. A 2023 study by professors from Emory University, University of Arizona, and University of Missouri found that a 100% stock portfolio split between U.S. and international equities outperformed the traditional 60-40 mix in terms of retirement wealth, spending power, and even legacy potential if that's a priority for you. You can read more about that study in this article from MarketWatch. See the URL below on the screen. So what is the takeaway? A well-constructed all-stock portfolio can be more effective even in retirement than the old balanced model. Morningstar now recommends lower withdrawal rates as low as 2.7%, especially for aggressive portfolios or longer retirements. Why? Because if your portfolio is larger, thanks to higher stock return, you don't need to withdraw as much of a percentage to meet your needs. Bigger portfolio, smaller withdrawal percentage, more flexibility. The internet changed everything in the 90s, and now AI is doing it again. We're living through a technological revolution that's reshaping industries, economies, and investment opportunities. That's why I stay heavily invested in sectors driving innovation, technology, healthcare, and a touch of gold. My portfolio this year has so far returned 24.97% year to date. And I sleep well at night because I keep a year's worth of expenses in cash. I'm not asking you to become a day trader or to chase meme stocks. I'm not suggesting that you start trading options or that you get into commodities or Bitcoin. I'm asking you to rethink the assumptions behind your retirement strategy. The 60-40 rule and the 4% withdrawal rate were built for a slower, simpler world. Today's world demands a smarter, more creative, a bit more aggressive, and a resilient approach. A 100% stock portfolio paired with a cash cushion may offer the best path to long-term growth, flexibility, and peace of mind. If this video has helped you rethink your investment strategy, give it a thumbs up and subscribe to get more insights grounded in economics, behavioral finance, and real-world investing. I'll be sending out more investment-focused videos to help you with your own investment decisions in the future. Drop a comment below. I'd love to hear your thoughts or questions on what I proposed in this video. I appreciate you tuning in, and I wish you the best in your investing.